Throughout this year, we've given you the complete arsenal for what you needed. So if it's your first time, you're in for a treat, I appreciate you. But let's walk through the arsenal of some of the things that we've told you to use to make you a better investor. So, number one, to load the boat, the best and ideal price if you want to look for a place to get a bunch of shares would be the 200-day moving average. It's a classic strategy, but most don't use it. People are always looking for an edge, something new, opposed to looking at what works. Use what works. Your savings rate plus the amount that you invest plus the number of shares will determine when you will be free. So put in chat, how many shares do you need to be free? We keep talking about generational wealth, but are we taking generational action collectively? That's what I want for us. So this year has been stressful as hell, but I want to make sure that we're doing our job to make it as peaceful as possible and easy as possible to understand this, so we can all do well together as a family. Number two, the 100-day moving average is a secondary entry point. So let's say it doesn't go to the 200 and we miss the move on the 200. We can then go to the 100. Number three, we told you the inverted yield curve predicts the recessions 100% of the time. So once the yield curve starts to invert, we have anywhere from 12 to 48 months to actually be in a recession. And at that point, when the yield curve inverts, you need to start looking at the companies that you like and highlight the areas where you want to buy if the market drops. Number four, 2 indexes and 2 tech. Number five, fear and greed calculation of where to buy good companies. Only with good companies. They have to be quality. They can't be low grade, cheap companies. Number six, we told you crashes only last less than 180 days. So if we know that the market with quantitative easing normally lasts 180 days, and since 1945, the average length of a recession is really only 11 months, we have to endure 11 months, between 180 days to 11 months of pain to enjoy a lifetime of freedom. I had a conversation with an investor who invested heavily in 2007 and heavily in 2008, and then also in 2020. I asked him if he would come on the show. He said no, he likes his privacy. I said I understand. But the gem that he did want me to share with everyone here listening tonight is that if we follow through and pass this information on to our kids and start them early, he said because of those 2 pullbacks that he's witnessed and been a part of, he's been able to secure himself, his son, his grandchildren, and the generation after. And the crazy part is, he never made more than $150,000 a year in corporate. Not 1 year. It's about personal sacrifice. We've given you the fundamentals that matter. So the founder, the character of the founder and the founding team. What's the vision for the company? Their unbreakable competitive advantage. If a company does not have an unbreakable competitive advantage, they will have a hard time being a leader. They may be a secondary or third best player in the space, but they won't be a preeminent player there. Pricing model is key. They need a loyal or ravenous customer base, and then they need a catalyst for multi-decade growth. If a company can't be dominant for 20 or 30 years, you shouldn't consider having it in your portfolio. We've also talked about how to exit and plan your exits with fib retracements. And then for generational wealth, you got to look to hold for 30 years. The blueprint is here. And the thing that I want us to focus on is eliminating the noise. There's so much misinformation and so much news that comes out every day. It almost makes you change your plan. But the best thing that you can do for yourself, your family, and then us as a community is have a plan that you do not waver from. A lot of you have been asking, is the fall of passive investing coming? I know there's some people who are beating up on it. $7 billion in outflow happened to the S&P 500 Vanguard. And even in Asia, passive investing has risen from 47.6% from 15.8% in about a decade. But look, mutual funds started in 1924. Index funds, rest in peace, John Bogle, started December 31st of 1975. Somewhere, and then FANG came, and that was the hottest thing ever, right? But at some point, there will always be a basket of companies for you to invest in. And whether you were paying attention to it or not, this entire time we've been showing you how to make your own, even with the assessment of 2 tech, 2 index. You don't need 42 companies inside your own personal portfolio. If you have 2 technology companies that you really believe in, and then 2 indexes, you have exposure to all the other companies that you think that you're missing out on. Less is more, right? Type in chat. Less is more. Because a lot of times that information happens and we take things out. And I've talked to several, even some people in Stock Club, like closed out of Tesla early in April or May because of fear. And then FOMO kicks in, it's like, should I jump in now? Let's wait. We want to take calculated measurements for when we want to buy these companies. Our job is to have the best companies in the world work for us. If you're not a better executive than Bezos or Elon, there's no reason we shouldn't have our capital working in that business to benefit us. So here's your 2021 plan. I want you to review what you invested in. I want you to write what went well. You have some big gainers. If it's a quality company, keep it, right? Third, I need you to write down what you wish you did differently. We all make mistakes, and mistakes are okay. This is how we learn. This is how we learn. We all make mistakes. Number 4, I need you to silence the outside noise. A lot of the times the people that are asking you to change your plan and say, have you considered this? And should you potentially, and I'm not telling you what to do because I'm not your advisor, but a lot of the times that isn't for your benefit. I showed you earlier an example. You guys heard us scream all year. Franklin Dynatech, QQQ, Tesla, AMD, Amazon, Nvidia, Microsoft, Apple, and other outlets and news platforms will say, well, what about this? You have to think every time that you change and take a company out of your portfolio, please write this down. This is really important. How many years of freedom are you sacrificing by taking that company out? This is a zero-sum game. You're either going to get more time or less time. There's no in between. I know with indexes, we have safety. But regardless of what happens, whether passive investing, and I know it became really hot. Of course, Money Master the Game and other outlets were a catalyst for that. Wealthfront, of course, was one of them as well. Betterment was another. But even if it goes away, you are equipped with everything that you need to know. Tie some of your money to the market itself, and then tie some to technology. And then if another industry becomes the preeminent leader, go there. If this is 1980, we would be doing oil and airlines. This is in 1970 and 1980.
My graduates from my school being Forbes, bag drop.
Bag drop.
A mic drop, bag drop.
Bag drop.